there's been a lot of changes this year, so we're going to kind of dive through those, have a little bit of research we're going to dig through just so we can try to grasp all the things that have happened this year. And hopefully, there's still some time to make some changes, in your business, and there's some other things you can do. So maybe we can do a little tax planning too to help along with that. So I'm Jason Blummer. As I mentioned, Blummer and Associates CPAs is our firm. I'm the managing shareholder, and it's good to have you guys on the line. Just like I do on every webinar, I try to give you a little audio technical guidance on our go-to meeting that you're logged into. You probably have a floating panel. Once you logged in, there's a floating panel. Floating meaning you can kind of move it around if you want by clicking the very top line of the panel. And that's where you can interact. Now, we're in a setting where everybody can hear one another. So if you haven't muted yourself, you want to mute yourself. And by doing that, you'll look on the panel and see your name. And there'll either be a green microphone or a green telephone beside your name, depending on how you're logged in, either through the computer. And if you've logged in through your computer and you're not on your telephone, and you don't have a microphone, that means we won't be able to hear you, obviously, since you're using the settings on your computer. So it might not apply to you, again, if you're logged in and just listening to me through your speakers. So you might be muted already. So just want to let everybody know we can't hear you if you're starting to talk either on the phone or have a microphone. So keep that in mind. So, well, again, it's good to have you guys, and let's just kind of start through this stuff. There's even been some recent changes. As of I think the 13th is when some of these things were changed. So just kind of want to go through what the Senate and the House are trying to get done, as we all have been here, and they've been trying to pass these the extension of these Bush tax cuts for a while, and a little extension on unemployment too. They've had some trouble getting all this through, so they finally got it through the Senate with a vote, and now it is to the House, and we're going to see what happens there, but we anticipate it may pass the House. Now, I think the House is potentially, or people are saying, as they're analyzing, who may be voting on this provision, under the past provision from the Senate, the estate tax is going to be put back in place, and I've heard it might be retroactive. Again, for 2010, there was no estate tax, so if you died in 2010 and your estate, had a value, you weren't going to pay tax on that estate. So, which is a huge deal. So it's really been the year to die, I guess, is what people have said. But this provision that just passed, again, the Senate, that's now gone to the House, would put the estate tax rate back at 35%. So we're hearing that there's going to be some votes, and that's one thing they're probably going to tweak on the House side. They're definitely going to try to get that estate tax rate back up. I think they want to probably get it up to 45%, and again, maybe make it retroactive for the whole year, is kind of what I'm hearing and reading. So that's about to happen, and we hope it does. We want the Bush tax cuts to remain in place. Let's see, specifically the provisions in this, let me just move to the next one. We'll hit some of that in a minute, but the provision in the state package that's passed would basically just extend the tax rates, the Bush tax rates, and tax cuts and things like that for 2 years, and would make the unemployment and extend that out for about a 13-month period, just to give some relief to those on unemployment. So that's what we're hoping. It's going to be about an $858 billion bill. It does some other things, as we mentioned here. It does an AMT patch, which they've got to patch that thing every year, so that more and more people don't get caught by the alternative minimum tax, which is just really another tax rate, really. Actually, anytime we're filing tax returns, we're always running it by the ordinary tax rates, but our systems are always running it alongside the AMT rates as well. Not a lot of people get hit under those. A lot of more wealthy people do. So that if wealthy people are taking, some itemized deductions and other tax breaks, AMT kind of adds some of those back and won't let you have them if you have income over a certain level. Well, more and more, the AMT patch has not ever been made permanent. So every year they've got to pass a bill that kind of allows a lot of people to bypass that and not get caught by the AMT. That is, people who really you wouldn't consider wealthy have been in danger of being caught by the AMT, so that you'll pay a higher tax rate than just the ordinary tax rate. So anyway, that's something that's been patched. They have to do that every year. So you know, we're hoping that stays. Some college tuition tax credits were extended. Bonus depreciation is extended. That's for good. That's good for businesses, allowing you to write off large capital assets. Equipment. It's really equipment that you're purchasing, and then some other child tax credits and things like that. So definitely a bill we needed. So that's been passed. Now, what I wanted to do is it's not necessarily tax planning, but I think the Obamacare provisions is what people are calling it, but it's really, if you remember, the Patient Protection and Affordable Care Act. That was a huge bill that's really, health care for everybody. And I don't know, I wanted to cover some of that because it's been so huge. So some of the stuff we're going to go over is really related to that. It's not necessarily tax planning, but I definitely want to hit it with everybody. And then some provisions of another bill are in there. You can see in the screen that it's from the Patient Protection and Affordable Care Act and the Healthcare and Education Affordability Reconciliation Act as well. So I just want to hit some of these. And as we know, a lot of these provisions are going to be rolling in over time. So they all didn't kick in immediately, when the bill was signed into law. I just want to hit some of those. They come in over the next few years. So let's kind of see what happens. Now, when the law was passed, finally, there are some provisions that became that happened 6 months after the bill was passed. So I believe March 23rd it was passed. 6 months later, on that anniversary, they had some things go ahead and kick in. So on September 23rd, a few things happened. So let's hit some of those. Again, these may or may not be tax related, but I think this was such a huge bill, we wanted to kind of cover some of it. Young adults now on their parents' health plans, they can stay on there even up to the age 26, and the young adults, they can even still be married, and that's okay. So that's a provision to try to keep people from having to kick their kids off of their plan when they turn a certain age or get married. So, and no more pre-existing conditions for children. So they're trying to make it where all children are going to be allowed to stay on there. No more lifetime limits. Really, the next two are kind of related. There's lifetime limits on a policy, and then your annual limits. So, lifetime are obviously, over the course of, and this is the lifetime limits are not something a lot of people talk about because they're so high in the millions and stuff like that. Oftentimes, so we don't always talk about these, but there is a limit, and if you've ever had major catastrophes that cost millions of dollars, you may have run into these that the insurance is not going to pay over the lifetime limit of your policy. So, but there's not going to be any more limits, any more lifetime limits immediately. So, and then the annual limits, they also want to limit those each year. Insurance companies try to prohibit what we can charge against our policy. So they're trying to make what they call reasonable. Again, they're trying to put into law what they think is reasonable. Obviously, they don't want the annual limits to be lower than $750,000 per year on a policy. And in 2014, you can see all the annual limits will go away completely. So 2014 is really, by some of my insurance friends, being called D-Day. So that's when really tons of stuff really hits. With what a lot of people call the Obamacare and health care for everybody. So it's just nationalized health care, basically. And here's some other things that happen. Right now, there is a provision, which you may have heard about in the news. There is a tax credit for providing health insurance to employees. This is for businesses. Now, this can be, it can be kind of complicated, but there's basically three hurdles. If you're a business that provides health insurance to your employees, there's basically three hurdles you first have to get over to even really qualify for the credit. You have to have fewer than 25 full-time equivalent employees. They're called FTEs, which is full-time equivalent. And even that can get complicated. What is an FTE? Well, they kind of go into that in some of the provisions. So if you think this might apply to you, really first thing you got to do is determine how many 25 FTEs you have, full-time equivalent employees. So that's a calculation. And then you average everybody's salary of all the FTEs, and that's got to be less than $50,000. So the average salary is $50,000 for all of your FTEs. You got to have fewer than 25 of those. So those are the first two hurdles. And then as a business, you have to pay at least half of the employee's health insurance premium in 2010 to take that credit. So it gets a little more complicated than that, but that's where you start, and you'll get a portion of the credit. But even if you find your average salary is lower, in some instances you'll even get a bigger credit. So they're really trying to push businesses that hire, I guess, poorer people, I guess is what they're trying to do, or at least target businesses that have more lower wage paid type jobs in them. That's who they're trying to target and give the benefits to. But as we know, it doesn't always work that way. Employers are going to be able to manipulate a lot of that, and there are ways to try to get your average annual salaries down. And obviously they can pay people under the table and then record lower wages. So I don't know, that would be a bad way to do it, but I've had clients that have tried things like that, and then of course we'd fire them. We don't take clients like that. So but that's interesting that they would try to legislate really how to do some of this. I don't know. I'm kind of against the legislation really trying to control our behavior and do some of those things and actually add value. But I don't know. Some of this may really help struggling small business that are actually paying and hiring lower wage employees anyway, so that could be good. Now this was an interesting one in the Obamacare, and I figured I would mention it, that insurance companies, they're going to limit really, I guess, what their overhead can be. It's kind of what they're doing. So the Obamacare provisions really say you can't spend more than 20% on costs other than providing medical care. So, and you have to start proving that too. I don't know if they're going to do that on their tax return, if there's going to be some kind of provisions for these insurance companies to have to prove that. I believe they're going to make them prove it. So basically, when you look at all of your expenses, if you're an insurance company, 80% have to be paid to provide medical care to your the participants in the insurance program, and only 20% can be paid used for administrative purposes, salaries, rent, office equipment. Paying that 20% also has to go into paying the commissions to the insurance salespeople, and those are who my friends are. The insurance guys are independent insurance sales guys, and they're like, our commissions are going to be limited, because so basically they're legislating what the profit can be in a business is kind of what's happening. So that's interesting. And if you have larger group markets, then you can only spend 15% on administrative overhead type stuff. So this Obamacare is huge. So a lot of the things as they roll in, again, we're still talking about current things that are in place now, but as these other years roll in over the next few years, different provisions will roll in. We don't know even what some of these will look like. So beginning in 2011, we're going to really start finding what some of this stuff actually means. So we're going to see that in 2011, employers are going to have to disclose the value of benefits that they're giving to their employees, and that'll be a number you put on your W-2. So that'll be something you have to start tracking in 1/1/2011, which you probably are tracking that anyway if you're giving health insurance to your employees. That should be something you're tracking. But now it may not be something you're tracking. Now it may be that part of your payroll program tracks the deduction you're taking out for your employee. For example, you're going to cover so much % of the medical for the employee, and they're going to cover a percentage. Well, their percentage is coming out of their check probably every week or every pay period. And so your cost, you just pick up the difference. But what most of our clients do? That health insurance expense they have, they don't break it down by employee. So they're going to pay the premium every month to the insurance company, say $2,500, and then they know Judy and John have had money come out of their paycheck, but the expense of $2,500 doesn't cover the $500 they were reimbursed from Judy and John of $250 each. So the difference of the, say, $2,000 that they've spent on expense, they've got to know which employees that really applied to. So there might be a change in your accounting that you need to look at. So that's interesting. And then coming up in 2011, if you spend money out of an HSA, and some other these same type accounts like an Archer medical savings account, if you come up with some of those in 2011, those medical things, you can't pay for those out of an HSA if things aren't for medical purposes, and you really never could, but they're just increasing penalties now is what they're trying to do to prohibit that kind of behavior. So those penalties going up from 10 to 20%. And then over-the-counter drugs, that's typically things people would pay for any kind of medical related expenses out of their HSA, and they're kind of now legislating that you can't do that. So if a drug's not prescribed by a doctor, you can't pull it out of your health reimbursement account or an HSA or a flexible spending account or anything like that, any kind of tax protected spending account for medical purposes. You just can't go to CVS or any kind of drugstore and buy what you want now. You're only going to be able to pull things out of there that are prescribed by a doctor. So those things are coming up, just things you got to watch for, and they're increasing penalties to make sure you don't do it. Now, again, this is a self-regulation kind of area. We ask our clients, when we see they've pulled money out of their HSA, we say, was all of this for medical purposes? And, they say yes. So, they're probably still going to say yes, I imagine. So that's just something you have to watch out for, at least know about that's going to happen. Okay, what's coming later in the Obamacare provisions, and again, these are not necessarily business and individual tax related things, but this Patient Protection and Affordable Care Act was so huge, we wanted to cover some of these things. So we've seen what's in place now in 2010, what's coming in 2011, more things come in later. Again, 2014 is a huge year. This is when the states are going to be creating these things called exchanges, and nobody knows what the heck they are. But states have to, have them in place by 2014. And some states, you have to be in a geographical area, but some states can even pool their resources together and actually, create these exchanges to try to provide, health insurance coverage that really, I guess, is going to compete with the private insurance market. So. And by 2014, everybody that applies for insurance has to be accepted by that year. And insurance companies can't really charge higher rates for sick people. So I guess, and that's in the those predetermined stages when you sign up for insurance. They go back to their underwriters and really determine pre-existing conditions and things like that. That's where they may typically kick out higher rates if they find you're typically a sick person. And things like that. Well, they can't do those things anymore, and they have some pretty complicated ways to weight. The premiums, for example, they can be weighted a little bit to age, but it can't be such a huge difference in weighting. They have to really determine. It's like a 3-to-1 ratio of age to premium, and I don't know really how all that works. It's pretty complicated. But there's just a lot the insurance companies, and insurance companies now should be sending out notices. You probably should be getting stuff in the mail that said your plan was grandfathered. These are all part of the Obamacare that they're required to do, and required to allow you to put children on policies. So, and there's still waiting periods, but beginning in 2014, insurance companies can't make you wait more than 90 days. I don't know if we've ever waited more than 90 days when we've applied for insurance, but I guess they could push it out even further. So that's interesting. Also in 2014, this is really interesting. You have to have medical insurance in our country, and you have to actually prove it. So beginning in 2014, on your tax return, your personal tax return, if you can't prove you have health insurance, they're going to create, a penalty. It's a federal tax, really, I guess, that will apply to you for not having medical insurance. So that's pretty interesting. And we're going to see in a minute, there are judges starting to call that unconstitutional because they can't legislate making you take insurance, I guess, in my view, and then the judge's view. But nonetheless, that's why we have our checks and balances in place, that Congress passes laws that the courts will then interpret and things like that. So we're seeing some of this play out. This was a big bill, very, very controversial. So we're going to see a lot of different lawsuits, and already have seen tons. So that is interesting. You will be penalized on your federal return if you don't have insurance. So, all right, still looking at later things that come up. And some of these, to me, are kind of scary. There's going to be federal responsibilities under this plan, and then state responsibilities. For example, federally, the Health and Human Services, the Secretary of the HHS is what it's called. They have to they have to certify what is a qualified health plan that's going to be sold within these state exchanges. And they do have some documentation already that it says they're requiring such plans. They have to provide essential benefits. And let's see, I got some documentation. I want to see if I can find what essential benefits they're going to require. The essential benefits package, which we'll see mentioned in a minute, as certified by the HHS, must at a minimum include ambulatory patient services, emergency services, hospitalizations, maternity and newborn care, mental health and substance use disorder services, including behavioral health, and prescription drugs has to be included, rehabilitative services and devices, laboratory services, preventive services, including services recommended by the Task Force on Clinical Preventive Services, and vaccines have to be included in there as well. And let's see, there's some other on chronic disease management. So these are just the basics of what an essential package, they're calling it an essential package. And again, the HHS, so the federal government now, not us, I guess the people that are applying for the insurance, but the federal government are going to be the ones that are going to determine what they think is a qualified health plan. So these state exchanges are going to be pretty interesting. Going to be a lot of different, legal entity setups for these state exchanges, and they have to be self-sustaining entities ultimately by 2015. And they can do, these state exchanges are going to be these entities that are created, and they can, give out, some of them are going to be giving out grants to what they're calling navigators, people who go out and educate the public about qualified health plans that the HHS is saying is qualified. So they not only put in place to really, regulate, national health care, but they really want the word out. So, they're gonna set aside some money to say, hey, get the word out that the state exchange is available for you if you're a poor person. And I guess they're doing that because if they, excuse me, if they say you have to have health insurance, then they're putting, some things in place that are going to show you how you can get that. So, they've got funding in this act, $6 billion actually, is going to help create nonprofit and member-run insurance companies that sell within the exchange. So you got this pool, this exchange, could be one state, could be 2 or 3 adjacent states that create this pool together. And nonprofit entities are going to pop up inside of there and start selling insurance. They mention member-run insurance companies selling within the exchange, and they want these entities popping up. And I guess they're going to, compete with private insurance companies right now. So, they're going to fund them too. So they're going to fund them. So they're working in competitive type entities into the system, automatically. So that's some interesting stuff. And we talked about the benefits package and what that includes and things like that. So, okay, so I just, I took a little time to go through that Obamacare, but we're finding, again, as I mentioned, some judges are starting to call Obamacare unconstitutional. We knew immediately once it was signed in March 23rd that a lot of attorney generals of a lot of different states jumped on board to some pretty large lawsuits against the federal government. And so just recently, and you probably heard about this, that Judge Henry Hudson in Virginia said Congress can't make people buy insurance. That's unconstitutional. And Ken Cuccinelli, I guess the Attorney General in Virginia, brought that case. So that may be, that's a state case right now, but that could go up to the federal courts and make its way up, and we could really see that affect how the law is put into place and what actually will apply and what will not. So and again, there are other states that brought lawsuits too. So I just wanted to throw in, after we went through those provisions, are they going to be considered unconstitutional? So interesting. Well, one of the bigger bills this year that's probably going to be the best one really for a lot of small businesses was the Small Business Jobs Act of 2010, signed on September 27th. So a lot of different, a lot of general provisions that they always try to pass every year. Some standard stuff they try to get in there to boost small businesses that they've been doing for the past few years. Part of this one's got a lot of SBA enhanced loan provisions and some other monies they're handing out to small banks. They're trying to really prop them up with some federal cash to get them to start lending, because as we know, credit in our market really greases the wheel of growth. So if people aren't buying and growing, and again, they can't do it without credit, then we're not gonna really grow over time. But I've seen, and not to put any fear in anybody's eyes, but I've seen they're really predicting GDP growth, the unemployment rate, and things like that really to remain at its current level for about 5 years. And I mean, I've just read that in some professional journals and things. Obviously those are predictions. So that's a long time, and it's going to really take that long for the housing market to come back, and when that stuff starts coming back, everybody's going to start feeling a little better. But I think, it's definitely going to take time. They're looking at a really good decade to try to, get our economy even back, just back to where we were, especially with unemployment. That's going to stay pretty high. They've lost so many jobs. It's going to take tons and tons of new development, new entrepreneurs to really build new businesses to get that unemployment rate back down. So anyway, I'm hearing a long time for that. So definitely 5 years, but 10 years until we get back to a new normal. So we'll see if some of that works. So some basic provisions: small businesses can write off up to $500,000 in new purchases of, these are new capital, large fixed assets in 2010 and 2011. That's called the Section 179, which you may have heard from your CPA. So, but just like a lot of recent tax bills and a lot of these kinds of bills, when you're doing your planning, just keep in mind that they're rarely permanent. So it does happen over just 2 years, and it comes back. So if you're a large company doing a lot of capital equipment purchases, those things matter, depending on your purchasing schedule and how many years you're going to do that. So you just have to keep that in mind. Bonus depreciation, we're going to see, these things really are often not permanent. So, but in this, after the Small Business Jobs Act was passed, you can write off 50% of assets as a bonus depreciation. So it's weird, Section 179 and bonus depreciation are very, they're somewhat related. Sometimes we'll apply the same thing, or we'll apply both of these to one asset just to get the largest amount of write-off. So you just have to, let your tax provider, help you know what's the best way. And they're typically going to take, as much write-off of any assets you're purchasing as possible to lower your profit in your business, so it'll save you some tax. So and you still have some time left over in the year. So just keep that in mind, that there is time still for tax planning. There are things, if you need to purchase them, you can do that. And so in tax planning, you always want to defer income if you can to another year and accelerate expense into this year if you can. And we tell people when we're doing tax planning, don't do stupid stuff. Tax planning is just, you don't do it only within itself. You got to consider so many other things within your life. If you have an aging mother or something, that matters, and you have to consider personal issues in tax planning. You don't go buy things you don't need, and I've seen people do stupid things that didn't make sense for their business or their life, but they did it just to save taxes. And that doesn't make sense. Sometimes you need to just pay your tax on your income and keep your cash, pay your tax, and move forward. So just keep that in mind when you're doing tax planning. Don't get your tax planning visor on and don't look outside yourself. Always consider many aspects of personal issues inside of your life when doing tax planning. So this other one, they're trying to spur new businesses and entrepreneurs to start. So they're letting them write off because typically startup costs you can't immediately write off until you're really operating or you're in business. So they're letting you write off 10 grand now in startup costs because of this bill. So if you incur any expenses starting up your business, they're going to let you write them off. And startup costs are almost any kind of cost it takes you to ramp up. Could be market research, employees to do that research. Could be the purchase of supplies and things. A lot of different marketing materials to get the word out and start your product, or do your initial advertising and marketing. And so a lot of that marketing, graphic design, and printing, that stuff's very expensive. So they're going to let you write off a lot of that. And there's a lot in this bill, but there's like an S corp built-in gain period. That's if you change from a C corp to an S, you got to calculate a gain, and they say one day you're going to pay tax on that. So there's a holding period that's been shortened so that you won't pay tax on it if you continue to run your business or don't sell those assets in the business that generated the gain. So that stuff you need to talk to your tax guy about. So, but there are some general business credits, and it's good. When they extend carryback periods, they've done that before, and we've used some of those. So the further they allow you to go back, the better, because we found with a few of our clients, they were profitable 5 years ago. Extremely profitable. So as the government gives us the availability to carry back a loss generated this year in their business, if we can go 5 years ago, that's quite a long time. And if we find profit back there, we start there and start eating up that profit, and we come forward through history and continue to eat up the profit generated back there. And so when they make the carryback periods longer and longer, it just means you get to go further and further back into history when you actually were making more money. And so so those are good. And we've used some of those. So, make sure if you have a loss this year, and in this case, just general business credits that you may get as a small business, but just remember to tell your tax provider or tell us that if you have, profit this year or have loss this year, but you had profit last year, that you want to consider, doing this carryback stuff. So that stuff's important. So. And some other things in this Small Business Jobs Act. Let's see, I don't think I have another. No. Yeah, in this Small Business Jobs Act, some other things like cell phones. You used to have to really document, what part of the cell phones you were using for business. So a lot of that's been taken away. And there's not these heavy burdens to prove that the cell phone was for, business purposes, and what percentage was used for personal. I guess they figured it was done really focusing your time on such a small expense that really doesn't matter, so they've kind of changed that. There's some penalty relief in here. Qualified small business stock if you sell, there's some benefits to that. So anyway, that stuff I won't go into, but you want to definitely, talk to that stuff with your tax provider. So let's see. Okay, and there are some other things that I didn't mention. Self-employed individuals, because of this bill, you can deduct your health insurance, right against your income tax. So let's see. I'm kind of reading through some notes here. So that's a big deal. So that'll save you on your self-employment tax. Some other 401k rollovers into Roth accounts, which are important, and a lot of that just, again, talk to your tax provider to make sure they address all that for you. Those are just some of the main things I wanted to hit. So the HIRE Act was another act signed, early, pretty early in the year. And this was when they were really trying to pass a lot of bills to spurn businesses to hire, which to me is weird. Because a business typically is not going to hire people unless they need to hire people. So it's really, this kind of bill only gives benefit to people if in fact they were going to hire anyway. I don't think it makes people hire, because if you don't have a position to put a person in, you're just not going to hire somebody just to get a credit. And the credit would end up being pretty small anyway. So these bills in my mind don't make us hire. They just give benefit to people who are going to hire anyway. So I don't know. That's just my opinion. And again, the HIRE Act, which stood for Hiring Incentives to Restore Employment, they're really targeting trying to get unemployed people back to work. That's who they're going to give you the credit for. So you would get a credit of the Social Security wage or the Social Security tax on hiring that unemployed worker. So it's about 6.2% of the wages that you would take in a credit if that person had been unemployed, and they have to be hired between this period, and so those are some things to consider. Now, one thing is true: the employee had to be unemployed 60 days before being hired, or at least work less than 40 hours per week. And there's an affidavit that employee has to sign that says, yes, I was unemployed for 60 days. And there's some replacement rules. I can't remember, but that hired unemployed person can't replace another person. It had to already be fill a job that needed to be filled. So I think what they're trying to do is not allow you to fire somebody. So they have to leave for cause. You can't just fire somebody and get a better worker in there just because you found an unemployed person that actually was going to be a better fit for your company. That's not really what they're allowing you to do. So you can't take the credit for that individual. They can't displace current jobs, I guess, is what the goal is. So that's interesting. And there's even more credit than that 6.2% wage. If that same unemployed person, if you keep them for a year, then that's a general business credit. And remember, a minute ago we talked about the general business credits. You can carry those back 5 years. So if you mix all these together, you really could actually get some pretty good tax benefits if in fact really you were going to hire anyway. So there's still time to hire people, but you only got a couple more weeks. You're only going to get a credit on a couple weeks worth of wages you pay that unemployed individual. So interesting. So that's the HIRE Act. Okay, yeah. There's also this. They're not going to let family and relatives. You can't hire them. They're not going to give you credits for that. And this does apply to nonprofits. So nonprofits can do this stuff. So that would be a pretty good law, if in fact, again, you're going to hire people anyway. So just and as we get close to wrapping up here, just a couple reminders. You may remember all those first-time home buyers tax credit. That seems like a long time ago to us tax providers. It just changed so much. In '08, they were giving you $7,500, supposedly, free money, as we kind of heard it then, but actually was it was a interest-free loan, because you were going to pay that back if you took that first-time home buyers tax credit on your '08 return. And some of our clients did. They did take that credit. So now's the year you got to start paying it back. 2010, on the 2010 tax return that we're going to file next year, you've got to put $500 and add it back to your tax effectively, and start paying the government. And that's going to be on there for 15 years. So that's part of tax planning. That's a $500 tax bill now you've got, and you've got to consider that for 15 years. So when you do tax planning, tack onto it $500 as far as what you're going to have to pay. So that's something to consider. And of course, then the people that took that in '08 felt stiffed, because in '09 and 2010 they got even more aggressive and gave first-time home buyers tax credits, and you didn't have to pay those back. So, and they even raised them too. So, just funny stuff has gone on really since this recession started. They have just really used a lot of tax policy, and now they've gotten into a lot of fiscal policy. They're really using the government to print money, and that gets pretty complicated as to what they're doing, to try to prop up our economy. The interest rates are so low, it's just amazing. So, but I mean, I see it, I see it changing a little bit with our small business clients, but it's just not, making anybody rich. So, I don't know. I see it as a mixed bag that we're actually getting benefit out of a lot of this. But, there are probably people it's helped. So, I don't know. I'm not a big government supporter of them getting into our stuff and helping us. So, I just don't like that, personally. So anyway, if you're the first-time home buyer's tax credit, you got to stay in your home if you took that credit, but you don't have to pay it back on just a few exceptions, like if the military orders you to move to another location or the homeowner dies or something like that. You may not have to pay it back. But I mean, if you get divorced or something like that, and the spouse gets the home, that spouse still is responsible to pay back that full credit. If you as a married couple took it in '08, so they're gonna they're going to get their money. So that's kind of the first time home buyer's tax credit. That's kind of coming up, and wanted everybody to remember that. Now the 1099 rules, man, those have been huge. They've tried to repeal this, man, a number of times, and just have not been able to do it. So this was in the Obamacare rule. It's kind of stuck in there. A lot of people wondered why. Well, provisions like this put in a bill that large are meant to actually try to pay for it. They're trying to show, hey, we're going to get money from here that's going to pay for all the costs of the national health care. So these things, there's been an uproar here. And, we may see IRS regulations proposed come down that try to ease a little bit of the benefits. I believe the law does give some leeway to the IRS to make some determinations as to what some of the language means in the bill and how you need to comply with it. So it's going to be, pretty burdensome, but who knows what we're going to see, the IRS propose that allows us to meet the needs of the bill. So there's really two I wanted to mention. One came from one bill, one came from another one. Not everybody knows about the second one, but you have to start sending 1099s to corporations now. It used to be 1099s were used to give to prove payment of income or for services rendered. So if you hire a subcontractor and they provide services to you, a 1099 was meant to prove, that person got income, so that in fact that person would report the income on their tax return. That's what they're trying to do. So they're trying to make people comply with tax and report their income. So that's not a bad thing. But it's switched now. The 600 limit still applies, but now it used to be if you're paying, an LLC or an individual as a subcontractor, you got to send them a 1099. Well, now you have to send 1099s to corporations too, and it's not just for services, but for really whatever you purchase from those entities. And so that's pretty rough. So a lot of people are making up a lot of bad stuff. If you buy $600 worth of supplies from Walmart in 1 year, you're going to have to send them a 1099. And I guess that's true, but I don't know. I'm hoping maybe the IRS will clear some of that up and say, for the larger stores, you don't have to do that for. I don't know what they're going to propose, but I'm hoping they're going to ease a little bit of the burden. But this begins in 2012. That is expenditures taking place in 2012. So you just have to really make sure your accounting records are in place. And most accounting systems, almost any accounting system, lets you track what you spent by vendor, and you're going to call a subcontractor a vendor, or you're going to call, QuickBooks certainly tracks all this for you. So, it's really going to allow you, I mean, these accounting systems really are going to allow you to track this stuff. Now, so really all it means is you need an accounting system if you didn't have one before, but, you need an accounting system for other reasons anyway. You got to know if you're making money or not in your business. So starting 2012, January 1, you need to start tracking everybody you're paying and the total that you're paying them throughout the year. So by the end of the year, you got to know if you've paid them more than $600. So, and we file 1099s for people, and so we can kind of, our system can really kind of import the data from QuickBooks, and then we file it all electronically, and we can even mail out the 1099s for you. So we hope it's not a huge issue for the small business owner, though. Obviously, it may generate more work and income for our firm. So it really they're propping up income, or they're propping up CPA and accounting firms is what they're doing. It seems so. But maybe it'll save taxes and people will start reporting more income. More, not sure. But now one that came from we just mentioned the Small Business Jobs Act, beginning this coming year. So in a few weeks, if you have rental property, you got a new 1099 rule. You have to give 1099s to anybody that provides you service. And so, often people have rental property. They have plumbers but even accountants or attorneys that provide services to that owner of that rental property. You're gonna have to send them a 1099. If you pay them more than $600, and it begins 1/1/2011, and again for rental property owners. So go ahead and start now. Again, if you're a rental property owner, you've kind of got to do what I mentioned for the first 1099 rule. You got to get your accounting in order. You need an accounting system that's going to track who you're paying and how much. And you're going to need their name, address, and federal ID number or a social security number, depending on if they're a business or if they're an individual. And again, most accounting packages are going to do that for you. So just make sure you have that in place. And they've kind of ramped up some penalties too on all these 1099 rules. You're going to pay a little bit more in penalty, where you may not have paid before. And so just a couple other tax issues you may want to consider. This is a year you can convert your traditional IRA to a Roth IRA. And again, we don't do investment planning in our firm. We refer that out to other people. And there are reasons why you would not want to do this, because if you do convert your traditional to a Roth, you're going to immediately pay tax on that. But there are reasons why you'd want to do that, because then a Roth can grow tax-free and you can pull it out one day when you retire with no tax. So a Roth can be good, potentially for younger people maybe. But again, you've got to talk to your investment person about whether you want to do that. But you can do it in 2010, and if you do it in 2010, you're going to incur some tax, but you don't have to pay that tax this year, so you get to hold off on paying it this year, and you're going to pay it. You're going to split it up and pay half on your 2011 return and half on 2012. And it used to be they would say if you have a certain income level, it might, let's see, it might have been $100,000 or something like that. But if you had a certain income level, you couldn't even convert your traditional to a Roth. But that's gone away too. They'll let anybody do it, so that doesn't matter. And we got a few clients that the adoption tax credits changed for them this year. They upped it $1,000. You get $1,000 extra, and that's a carryover credit. But this year it's refundable. So if you use $500 of the credit this year, simply because you only had $500 that you owed tax on, that is, the credits typically will eat up your tax, but it will only eat up your tax to zero, and then obviously it won't eat up any more tax, and it'll say carry this credit over to next year, or carry it back, in some instances we saw. But when a credit becomes refundable, and you owe $500 for the year in tax, then it might say, this will eat up $500 in tax. But then the rest of it, they're just going to pay you a check for. So you're going to make money on this. So that's a pretty cool provision. I've actually adopted a child from China, so I'm into this kind of stuff. I like this. I want people adopting other kids, so I think it's very important. So that's it.